It's a situation where now the prices are beginning to rise, going into new high ground. It's produced a sort of dichotomy in terms of behavior. In the West, until very recently, people took the advantage of these high prices, quote unquote, to sell their gold. But the Chinese households are taking a completely different view. They're seeing the price of gold in yuan rising, and they're thinking, we better have some of that. So you can see that there's a beginning of a stampede going into physical bullion, even after something like 27,000 tons of gold has already been acquired by the public in China. This really is going to drain all the physical liquidity, so far as I can see, out of the West. And this is why the gold price is rising and rising and rising.
According to Alasdair Macleod, head of research for Goldmoney, there has been a striking shift in recent years as physical gold moves from Western markets to Eastern economies, particularly China. This trend is largely driven by the growth and influence of the Shanghai Gold Exchange, a crucial platform enabling substantial withdrawals of gold from vaults for various purposes like jewelry and personal bullion investments. Despite a temporary pause in May and June, China continues demonstrating strong interest in official gold purchases, maintaining relatively low bullion holdings compared to its reserves amid ongoing geopolitical tensions. Currently, China's official gold reserves stand at 2,264 tons, representing 4.9% of its total foreign exchange reserves, the highest recorded level. Following Western sanctions freezing $300 billion of Russia's reserves, constituting half of Moscow's total, the PBOC's renewed gold purchases over 18 months played a crucial role in pushing global gold prices to record highs by 2024. China's economic landscape further underscores this trend, with household savings equivalent to 35% of GDP, approximately $6 trillion, seeking secure investment avenues. Gold has emerged as an increasingly attractive option amid cooling property markets and lingering equity market uncertainties. While Western markets historically see high gold prices as a cue to sell, Chinese households interpret price spikes as an opportunity to accumulate more gold. Interestingly, Western investors have not followed suit despite recent record-high gold prices. Their continued liquidation of gold holdings in early 2024 contrasts sharply with Chinese consumer behavior, highlighting divergent views on gold's role. Alasdair asserts that Westerners often view gold within investment cycles, but Chinese consumers perceive it as a durable store of value and a hedge against economic volatility. This behavioral contrast underscores the evolving dynamics in global gold markets and the shifting influences between East and West. We will present clips from Alasdair Macleod's interview, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
That's a very interesting point because we've known for a long time that physical bullion has been migrating from West to East. China basically has absorbed an awful lot of gold, both the state with hidden reserves and also the people. Since the Shanghai Gold Exchange opened, somewhere around about 26 to 27,000 tons of gold has been withdrawn from the exchange's vaults, and that goes into jewelry and also bullion stored outside the system. And on top of that, there is bullion stored within the system, whose beneficial ownership is Chinese citizens through their bank accounts. So the demand has been enormous. Now, it is beginning to accelerate, and it's a number of unfortunate events seem to be coming together. The first thing to appreciate is that China's household savings rate is 35% of its GDP. Now, 35% of China's GDP is the equivalent of $6 trillion. So you have to ask yourself, where do those savings go? Well, property, it used to go a lot into property. Basically, they used to, for the pension fund, quote unquote, they would just buy off-plan apartments in high-rise buildings in these new cities, and you just buy them and you just sit on them. They, maybe empty, maybe put a relative in it or whatever eventually. You use it if you visit the city. But basically, that game is over. Property prices are now falling. we know that the whole of the construction industry is in dire straits in China. So what else? Well, there's the stock market, but the stock market has been a bit better this year, but that is after 3 years of bear market. Now, I can see some of the household savings going into stocks, but very, very limited, because you're not going to get the bullishness that you would associate, let's say, with the healthy market. So that's out. And this is why the $6 trillion, the bulk of it, goes into what are called certificates of deposit. Now, a Chinese certificate of deposit is basically a 3-year fixed deposit for individuals. And it's been going into those really for the lack of anything else. Now what's happening is that people are beginning to buy gold. So that 35%, $6 trillion equivalent, a fairly large portion of it is beginning to overhang the physical gold market. The reason that this can accelerate very quickly is that all Chinese banks offer gold accounts as well as ordinary yuan deposit accounts. Now, all you need to do is have the equivalent of about $70 in order to open one of these gold accounts. So it's a situation where now that prices are beginning to rise, going into new high ground, it's produced a sort of dichotomy in terms of behavior. In the West, until very recently, people took the advantage of these high prices, quote unquote, to sell their gold because they've been sitting on it for so long, and whatever. Anyway, they think, oh well, we all
just
get
a
out.
pet rock for them.
Yeah, but Tom, this is the sort of behavior that happens at the bottom of a bear market, and yet we've got it going into new high ground. But the Chinese households are taking a completely different view. They're seeing the price of gold in yuan rising, and they're thinking, we better have some of that. So you can see that there's a beginning of a stampede going into physical bullion, even after something like 27,000 tons of gold has already been acquired by the public in China. So this really is going to drain all the physical liquidity, so far as I can see, out of the West. And this is why the gold price is rising and rising and rising.
The U.S. Federal Reserve recently surprised markets by signaling a single interest rate cut this year, diverging sharply from earlier expectations of multiple reductions amid easing inflation pressures. Previously, analysts anticipated 3 rate cuts by the end of 2024, but the Fed's revised outlook, revealed after a meeting of key officials, now points to just 1 reduction. This decision comes as inflation, which measures the rate of price increases, moderated slightly to 3.3% in the year leading up to May, down from 3.4% in the previous 12 months. Despite this, concerns linger regarding the enduring effects of inflation and the broader economic impacts, especially in sectors like commercial real estate, where defaults are mounting and posing risks to bank stability. Alasdair Macleod challenges the notion that inflation is under control, dismissing it as wishful thinking. He emphasizes that persistent budget deficits in the U.S., amounting to approximately 9% of GDP, continue to erode the dollar's purchasing power. Alasdair also underscores the role of non-productive lending, such as increased credit card debt, in exacerbating economic vulnerabilities. Alasdair warns of potential corporate defaults and strains on financial institutions, driven partly by interconnected global financial markets heavily reliant on derivatives. He argues that these factors could amplify any economic downturn, potentially triggering global repercussions.
Inflation is yesterday's problem. That is a load of rubbish. The real driver of the loss of purchasing power of a fiat currency is the budget deficit. And the budget deficit in America, for example, I mean, it's funny enough, I've just put this together for an article which I'll release tomorrow. But if you look at the budget deficit, that is by far and away the most important definer of the loss of purchasing power of the currency. I mean, we're looking at something like 9% of GDP, by my calculations, going back, because you've also got to factor in changes in the, in the volume of savings and things like that. And also you've got to factor in non-productive lending, which is basically the increase, if you like, of credit card debt and so on and so forth. It's all that non-productive credit going into the economy. And that I reckon on my numbers is about 9%. If you get taking the second half of the last fiscal year and the first half of this fiscal year. Now that inflation is in the pipeline. Now, is it going to go down next year? No, it is not. And the year after? Certainly not. So the idea that inflation is yesterday's story is, I'm afraid, wishful thinking. I would very, very strongly argue that the evidence is that markets will take control of bond yields in particular, bearing in mind that the US government has something like 130% debt to GDP. It will find itself paying higher yields in order to secure its funding, not lower yields. The effect on companies, zombie companies, will be to drive them out of business. The effect on banks will be substantial increases in non-performing loans. We're already seeing this with the commercial real estate sector, for example, which has sort of wiped out, looks like it's wiping out about half total US bank equity. Ways in which this can be handled, but it ends up with exactly the same result, which is not good. I mean, the one is that the Fed lets the market effectively lead it by the nose in terms of its interest rate policy. Mm-hmm. And that way secure the purchasing power of the dollar. It decides that it's got to abandon the rate of the dollar and really look internally to try and prevent business failures in the domestic economy, banking failures in the domestic economy, and all the rest of it. And, I mean, I'm sure in the Fed, there's still people who believe that if you've got a healthy stock market, then that gives confidence into the economy. And that's a very important part of the whole picture. Now, under those circumstances, then you can kiss goodbye to the dollar's value on the international exchanges, changing differentials perhaps between the dollar and the euro rates. I think really, this would really be shown up in the value of the dollar measured against the value of gold, because we're comparing a fiat currency which is getting into credit difficulties with real, legal, no counterparty risk money, which is gold. Mm. So, this again, this is a crisis which is playing into higher gold prices measured in dollars, I'm afraid.
Analysts predict that China will continue substantial gold purchases for years, potentially increasing its gold reserves to 10% of its total holdings, up from the current 4.9%. This could translate into an additional $170 billion investment in gold. Consequently, these continued purchases will likely increase gold prices, reflecting increased demand and the strategic shift in China's reserve management. Share your thoughts on Alasdair's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.